accounting. I will start the presentation on slide number 2. The second quarter has clearly been characterized by the ongoing pandemic. We have had a high activity in the bank to support our customers in different ways. We have also kept a high speed in our development of new tools to support both our customers and employees. And we have clearly seen results of these efforts. Swedish private customer ranks Handelsbanken highest of all banks in terms of how the pandemic has been handled, and customer satisfaction has further strengthened during the spring. We have also seen a strong growth during the quarter. Both lending, deposits and mutual fund volumes have grown nicely. This, in my mind, is evidence of satisfied customers with a strong trust in the bank. During the quarter, 2 of our home markets entered into a real low-rate environment, and that happened quickly. I will get back to that, but it has had a short-term impact on net interest income. We wanted to be well prepared to support our customers in the best way when the pandemic started. We secured early on an even stronger liquidity reserve. Given the turbulent start of the quarter, this came with an extra cost which is temporary in nature. The bank has also built further capital during the quarter, and at the same time, our credit quality is stronger than in a long time. Loan losses are at a very low level. I will get back to that. Looking at the second quarter result on slide number 5, we can see that it was stable. In Q1, we had some items directly related to the pandemic. We got an impact of over 800 million SEK, not least from the extra credit loss provisions we took at the outset of the pandemic. In Q2, revenues were down somewhat, which was expected given the turbulence in the markets and economies. Costs were stable and loan losses were close to 0. Common Equity Tier 1 ratio strengthened by more than 1 percentage point. So, all in all, a stable quarter, even though some lines in the P&L moved quite a bit, but yet in a way we could expect. On slide number 6, we take a look at net interest income. The strong volume growth added 188 million SEK in the quarter. We wanted to prepare for any size of growth, so we built further liquidity, also for different scenarios of the crisis. That addition of liquidity came at a cost of 236 million SEK, largely because of the volatile market initially. For example, the bank opened up the European market for bond funding in early April. This extra cost will be much reduced in the third quarter and will be gone in the fourth quarter, all else equal. Norway and UK entered into a low-rate environment very quickly. This had an immediate impact on deposit margins that fell by 170 million SEK. This change will not come back next quarter. Just like we have talked about during the quarter, one has to expect lending margins to come under pressure in the beginning of a crisis before new price levels have been established. The cost of that was around 150 million. So, out of the 600 million drop in net interest income in the quarter, at least 400 million is of a temporary nature. And again, given the big turbulence in the world during the spring, it is quite expected. Now to slide number 7, please. In most of our home markets, we have had a low and even negative rate for years. Now Norway and UK are also in a similar situation. Initially, as I mentioned, that comes with a cost. But over time, and as you can see from the slide, there is a clear contribution from volume growth in the bank, not least in lending. Loan demand, of course, benefits from low rates for the customers. The latest quarter does look challenging, of course, on this slide with the reduction. However, going forward, we have good reason to believe that volume growth will remain the big driver of net interest income rather than margins. Margins over time always move up and down. On slide number 8, We can see the total lending and deposit development in the bank. During March to May, the bank was the largest net lender to non-financial companies in Sweden, with a share of over 25%. During the latest part of the quarter, we saw a declining need for new credits for the companies, but compared to 1 year ago, we have built a considerably larger corporate lending portfolio in all our home markets taken together. At the same time, corporate deposits have continued to grow. This underlines that the companies are strong, but they have also put a lot of trust in the stability of Handelsbanken. On mortgages, the stable growth has continued. We had expected a slowdown during the spring, but in most markets it has been almost business as usual. We were largest on new mortgages lending in Sweden up until May, but with a share below of our total market share. We have continued to launch new digital mortgage solutions for the customers and branches. These will both add value to the customers and make the work in branches more efficient to free up time for them. Household deposits have grown strongly during the quarter, and the earlier growth trend has strengthened further. Now to slide number 9, please. Fee income is down during the quarter, which was also expected. We had a strong start of the first quarter before the stock market crash and outflows in March. We see the impact here. During the second quarter, inflows have been strong. Stock markets were up, meaning that we are back on levels which, if they remain, bode well for this part of fee income going forward. Payments, roughly 15% of fee income during the quarter, have also been affected, as expected, by lower use of cards. The largest part of our card business is related to private cards, which have done better than corporate cards. We have also seen private cards developing in the right direction again during the later part of the quarter. We continue to develop our offering within the saving area, among others, and we can see that we have a nice potential still in our fee business after the natural drop we saw in the second quarter. On slide number 10, we take a closer look at the mutual fund business. Our strong position was further emphasized in the second quarter. In Sweden, we had 38% of net inflows in June. In spite of general outflows in March, all in all, we had higher net flows in all our home markets in the first half of 2020 than in 2019. Our unusually high advisory activity during the spring is an important explanation behind the good development, as well as our continuous efforts within sustainable asset management. Now, changing subject, we're moving to slide number 11. We continue on the path of change we started last year, making the bank more focused and with a less complex and more efficient structure. This means that we focus on our core customers and their needs. We develop our offering of the products they need and stop providing services that don't support the core customer business. It has essentially moved on according to plan during the pandemic, even though some measures have taken a bit longer time due to close downs. At the same time, our development, not least of a new digital tools, has been done with a high tempo during the second quarter. We remain with our guidance of the total cost impact down 1.5 billion SEK, all else equal, by the end of 2020. Measures agreed and taken so far imply 550 million SEK in annual cost reductions. About half of that, 70 million on a quarterly basis, can now be seen in our numbers. Our cost focus is strong and will remain so. We will get back to the position where Handelsbanken should be, a truly cost-efficient bank, and this is definitely a step in that direction. And from here, I will hand over to you, Carl. Please continue.
Thank you, Carina. Please go to slide 12, where you can see our cost development, and you've seen this quite a few times before. It shows that the underlying cost growth continues to abate, now around 2.5% year-on-year. Looking quarter by quarter, you can see that costs are down somewhat, both compared to the second quarter last year and the first quarter this year. The impact of the cost reduction that I just talked, or that Carina talked about, can be seen in the post other expenses. We have decided to step up the speed even further within the entire financial crime prevention area. This is a key focus for Handelsbanken, and we will continuously adapt to the changing world around us. It is of utmost importance to us that we do all we can to protect the bank from being used for criminal purposes. We will therefore spend more this year than we have previously said, 1.5 billion rather than 1.2. In the first half of 2020, we spent around 660 million, so it means some increase during the second half. Slide number 13, please. As Carina said in the beginning, we have secured a really strong balance sheet throughout the ongoing crisis. Our common equity Tier 1 ratio improved by more than 1 percentage point to 18.71. 1871 happens to be the year when Handelsbanken was founded, and that's why we used the 2 decimals this quarter. This means that we are 170 basis points above our target range. This will not render any particular action from us now. We think it's prudent and very much Handelsbanken to be extra well capitalized in a crisis. On top of that, we know that the capital requirements will move up going forward, as we have talked about before. Next slide is number 14. And then moving into loan losses. Our loan losses in the quarter ended up just below 100 million. This may come as a surprise to some, having such a low level in the middle of a crisis. So again, I want to start to remind you of the EBA stress test. It's now updated with the new EBA transparency exercise published in June. Just like before, Handelsbanken has the lowest share of problem loans of all European banks. We are clearly below even the other Nordic banks. This is a very strong starting point. Most of the times when there are no loan losses in the systems, you will not see this difference. It will not be transparent. But it becomes more transparent in more challenging times. Moving on to another familiar slide, please go to slide 15. This picture shows our long-term loan loss history. We are always humble about loan losses, especially in a crisis, but it's clear that over many decades, Handelsbanken has distinguished ourselves in crisis by having a stronger credit quality than other banks. We are running our bank locally, focusing on clients with a strong repayment capacity, regardless of sector. On top of that, we have a very high share of secured or collateralized lending, typically in properties with low loan-to-values. All of this should help in a crisis like the current one. Slide number 16, please. You need to look 13 years back in time to find a lower loan loss number than the one we have posted in the second quarter. We had 11 million of losses in stage 3 in the quarter, by far the lowest level since IFRS 9 was introduced in 2019. This quarter, we have changed the macro scenarios quite a bit. In short, the 2020 scenario is now forecasting a GDP downturn of close to 5% in Sweden, with unemployment close to 10%. In Europe, the scenario is even worse. As you know, the macro figures are used to calculate the expected credit losses in our entire portfolio. This adds 200 million to the loan loss provisions. In the first quarter, we made an overlay to specifically capture the impact of the pandemic, resulting in an extra provision of 440 million. In the second quarter, that provision has decreased somewhat, which adds positively to the loan loss line. This in spite of the fact that we have extended the universe of vulnerable sectors that we stress on the back of COVID-19. Finally, we have some mix improvements and other things that reduce the need for provisions, and all in all, we end up with 97 million in the quarter. On slide number 17, you can see the scope of exposures that we have looked to include in the COVID-19 stress overlay. All in all, 109 billion out of total exposures of close to 3,000 billion. We have looked at the individual exposures in this group and excluded 23 billion on an individual basis from a credit risk assessment. But still, the list of vulnerable sectors is 27 billion larger than in Q1. We've also manually migrated all exposures in the vulnerable sectors with a risk class normal or worse into stage 2 from stage 1. Further, we are including all our non-property SME exposures into the stress, as well as non-mortgage household exposures. On slide number 18, the scope of our total overlay is summarized. In terms of sectors added, it's primarily retail space properties that are now included in the stress. In total, just over 7% of our exposures are now included in the manual COVID-19 related overlay. But again, the change of macro scenarios used for the entire portfolio means that the IFRS 9 model is capturing most of the pandemic impact, which reduced the need for manual overlay compared to the first quarter. On the next slide, number 19, we like to offer you some insight into our property management exposure. During the first quarter, we got a lot of investment questions around this, so we think it's prudent to be even further transparent here. About half is lending to residential property companies and half is commercial. As you know, we do our property lending locally in every branch. We look for good customers with strong repayment capacity. That's the first line of defense. We never lend only on the basis of the collateral. The cash flow must be strong. But then, of course, we want the collateral as well, and then loan-to-values matter. As you can see, LTVs in our portfolio are generally very low. Residential properties in Finland have a high degree of government guarantees behind the collateral, hence the higher LTV. In our report today, we also publish tables where you can see more granular what types of collateral is behind our property lending in the different home markets. You can see that at page 43. With average LTVs of around 50 and an extremely high share below 75, as you can imagine, the collateral we have from our strong customers are also resilient even to sharp property price declines. The same is true for our mortgage lending. Further back in the presentation, you will find the very strong stress test results on our mortgages used to issue covered bonds. Slide number 32 really provides a lot of detailed information about the manual overlay. We talked a lot about this one in Q1, and it's now updated with the new stress test. I just want to emphasize that even with a highly stressed PD value, provisions remain limited. One important reason for that is the low loss given defaults in our portfolio, as can clearly be seen here. Again, a high share of collateralized lending is one important explanation. So, finally, on slide 20 to summarize. We continue on the path of change in the bank that we started last year to make the bank more focused and less complex. Our profit is stable and cost development continues in the right direction. During the second quarter, we had a very high activity with our customers and also in our digital development. We have proven that we are ready to support our customers throughout this evolving crisis. This has been well appreciated and our customer satisfaction has strengthened even further. Business volume had a strong growth. To be well prepared in this crisis, we took a cost to further build up the liquidity reserve. A couple of our home markets have joined the group of countries with a real low rate environment. Initially, that came with a cost, but over time we believe it's supportive for the business. Our capital position is strong and loan losses are close to zero in the quarter, and we look forward to an exciting fall with a positive view. Our biggest hope is, of course, that the pandemic will ease its grip on the world, but we are prepared for all sorts of scenarios. And with that, I thank you for everyone for listening, and we open up for questions. Thank you.
Thank you. If you'd like to ask a question, please dial 01 on your telephone keypads now to join the queue. Once your name is announced, you can ask your question. If you find it's answered before it's your turn to speak, you can dial 02 to cancel. So once again, that's 01 to ask a question or 02 if you need to cancel. Our first question comes from the line of Chris Hartley at Redburn. Please go ahead. Your line is open.
Hi there. Thanks for taking my questions. The first one is on your reserving on that slide 32 that you talked about. And I just wanted to ask specifically about the SME corporate line. So I noticed that you stressed the PD only by 10 basis points, whereas the stress seems to be larger for some of the other, apologies for my doorbell going there, some of the other sections. Can you sort of tell us a bit more about what's in that book and why the stress is lower? And then second of all, just on the AML costs, please, can you give us a bit more detail on why those expenses are increasing there? Is it something specific you found? And maybe how would you think about the level of those going forwards? Thanks.
Okay. Well, first of all, obviously, you see that we have stressed all the property lending you see above, defined as we moved into the vulnerable sectors, and we defined them, and we've been transparent around them. So the other part of the SME business, which are not included in vulnerable sectors, are the ones we stress and make the line transparent on what the sums are. So in this sense, we've the limit or the ratio of the PD stress is obviously deemed to be lower on this part, and that's the reason why we stress it by just 10 basis on that line. And moving into the AML perspective then and financial crime prevention, we see three types of cost on that line. First of all, we're developing processes and systems for the KYC process, and that's something we invest in right now, and that's something which will prolong with us that investment line for a few years more. Second of all, we invest in systems and processes for transaction monitoring. I notice if the clients behave in a different fashion. That's also something we invest in and which will live with us for a few years as well. The third cost item on the AML or FCP line is rather to go through all the clients and create the correct legacy of customer information, and that's something which we have increased the pace on, and that's the reason we're increasing the pace now. We want to move fast forward there and have everything in check. We're not going to guide on 2021 cost yet, but it's obvious to us that IT investment cost will keep being elevated for a few more years, but gradually the cost of updating the client information will abate with time.
Okay, thanks. And can I just maybe follow up on that? It's actually sort of regarding Octagonan. So to what degree is loan loss experience kind of incorporated into your thinking around Octagonan? So say you have much better than expected loan losses, but there is a bit of a slip on costs. Is that still is that good enough, or is sort of the cost line really what the focus is when it comes to thinking about or whether Octagonan will get paid?
First of all, I think Octagonan cost is obviously cost we like, so we want to move back as quick as possible and pay out Octagonan. But obviously it is a board decision, and the conclusion earlier on has obviously been that we're not value generating enough. We believe that we will close this year with obviously ROE in a sense with the motivation of paying out the full Octagonan. We will need to leave that question to the board, and they will have to decide in the next springtime of if Octagonan will be paid out or not. The reason why we haven't accrued an Octagonan this quarter is the same as last one. We think it is not visible enough, the market circumstances, and we will wait. But if there's reason to, we like to get back to pay Octagonan, and it's a cost line we like in the bank. One of the few ones, I should say.
That's great. Thank you.
Thank you. Our next question comes from the line of Robin Rom of Kepler Cheuvreux. Please go ahead. Your line is open.
Yes. Hi, good morning. Thank you for the presentation. Thank you for taking the questions. So how should we think about the credit losses from this point? So if we assume that the development of the economy is hypothetically exactly as you line out in your base case, should we then expect that credit losses per quarter should go back to the level of where we saw the past couple of years, 200 to 300 per quarter? That's my first question. Thank you.
I don't think you can make that kind of judgment of our portfolio. Many of the questions around the credit losses in the last quarter and most likely this quarter as well is between understanding the way we do our credit decisions vis-a-vis the majority of the banks. And many of the banks do top-down ratios, and yes, I think the logic you're posing could hold true for a bank like that. If we go back to normal times, a top-down approach to credit lending might go back to the normal ratios. We do bottom-up. We have local branches in a local community offering lending to the clients which we think are good and that needs it. So we don't like credit losses at all. We like to approach zero on that line. What the outcome will be is going to be fairly idiosyncratic, I think, in the future. So I don't think you can actually guide on the credit. We think or at least history tells us we have a quite competitive credit loss line, but the future will have to tell.
Lars Höglund here. I'd like to add one point to Carl's point there. I mean, if you look back, even back to 2008, 2009, the loan losses we had at that time, you could clearly see that these were focused on a very small number of exposures. So idiosyncratic cases again. We had another case last year in Sweden. But the portfolio as such has not really moved from the changing macro environment. So guiding on loan losses is something we don't do for that reason.
Thanks for that, Lars.
Okay, thank you. Sorry to dwell on the loan losses, but would this sort of bottom-up decentralized approach make you more, do you think would make you more reluctant to take upfront provisioning than peer banks, for example?
Could be, I don't know, or if you work top down, you might have less transparency on individual exposures. What we've done is, first of all, we do IFRS 9 modeling with the new macro updates, then we do the COVID-19 overlay, and then we go through exposure by exposure, look at the individual levels and make a decision and see if that's a reasonable amount. If you do lending top down into sectors with a diverse set and with no specific knowledge to the individual exposures, you might have more challenges with having a view on the individual credit. So I guess it's up to you to decide on.
But I think, I mean, just to clarify also, I think the fact that all our credits are being monitored from our branches locally, of course, means that they are really close to the customer and can really take quick action if something starts to deteriorate. So I think it's rather the opposite. I mean, from a bottom-up point of view, I would say we are quicker in taking action, including making provisions if needed.
Okay, thank you. And then on lending margins, looking ahead, so we've seen various interbanking rates going down again to the end of this quarter. So how do you see easing on lending margins from this point? I mean, excluding the more temporary effects from funding, etc., but more looking to the competitive picture on, I guess, both household and corporate lending.
Well, if we go back to slide 8, obviously there are multiple things happening beneath the surface. I think we'll have to dig into it. Obviously, lending margins on the corporate side has been poor this quarter, and that's due to a lot of the volume is obviously RCFs and guarantees, and obviously and they are issued at pre-negotiated levels. So this quarter has a poor credit margin on that part. That will most likely adjust going forward, obviously. Then you go into mortgage lending, and we see obviously quite a fierce competitive pressure there. On the quarter, we see fairly little adjustment, a slight deterioration, but obviously we see the new lending at lower levels than book average. In most of the crises, you normally see credit margins picking up. I think we're much more humble this time because most of the banks will be in a good situation with strong balance sheet, and they want to be in the competition to win all the lending. So I think the competitive climate will be more fierce this time. Then perhaps it's worth to mention as well that looking into the interest rate net margins on this quarter, obviously, if you look about the deposit side, obviously that Norway and UK entering into more or less a zero rate climate, we have notice periods on roughly 80 million on these parts. So 80 million should adjust, and they should more or less have adjusted now or very, very soon into the third quarter. So there are multiple issues playing in this margin picture. But generally, we believe that there will be pressure still on margins. But we have a lot of short-term effects in this quarter which will abate.
Okay, thank you very much. And then just a quick follow-up on Octagonen there. You said that the final decision is normally taken during the spring. Given the uncertainty that we see now, should we expect that you don't make basically any allocations in the coming quarters, but if you do an allocation, you'll do that in Q4?
I don't think you should expect anything on that line. If we think the picture is transparent and we think it's easy to judge what the consequences will be, we will take the cost then as soon as possible.
Okay, thank you very much.
Thank you. Our next question comes from the line of Magnus Andersson of ABG. Please go ahead. Your line is open.
Yes, hi. Just a very quick follow-up on the Octagonen, since it's quite important. Just to make it crystal clear, the reason why you did not make a provision this quarter was, as I read you, the continued uncertainty and not related to the fact that your costs, all else equal, will be 300 million higher than we thought earlier because of this new AML guidance. Is that correct?
Agree.
Yeah, okay, good. Then on NII, you clearly state that the 236 million will come back and be back in Q4. And then I guess up to the 400, you have the 80 million you mentioned on lower deposit rates. And I guess that up to the 400, the rest was due to improved lending margins in home markets where you have the minus 151. I was just, for modeling reason, wondering, you also write about a one-off cost of the insurance guarantee of 57 million. Is that just a Q2 thing, or has the level increased there so that we should put that into Q3 and Q4 as well?
No, it's a good question you're posting, Magnus, and I will have to be a bit more clear on this one. First of all, the temporary effects to the NII we see are FX of 90 million. They are the government guarantee, as you're alluding to, which is 60 million, and that's a one-off, just hitting the Q2 results this year. Then we have the notice period of 80 million estimated, and then we have the liquidity reserves of roughly 240. This accumulates to 465 million, above 400, which we rounded it off to, but 465. So 3/4 of this NII drop, we believe, are temporary.
And also, just related to that, when I look at your note 17, we can see that the cash and balances with central banks in US dollars went up to, I mean, it's usually been between 50 and 100 billion. It went up to 350 or more than that in Q1, and it remains at 300. Is that the number that will come down during the second half, or? Yes. I guess that's part of the problem.
Yeah, I think.
Okay, so that
it's. I don't know. I don't know if you're correct. It will most likely come down because the stress levels in the market has come down, and then especially financial companies put less cash in our deposits. But they obviously, and we don't make money on them. We place that cash on Fed. So that balance will come down, but the NII and that will obviously hit perhaps the average margins, but the temporary effects is rather to the answer I gave earlier on. And please, Lars, add.
Yeah, just to add, I mean, part of that increased balance with Fed was also financed not only through overnight deposits, but clearly through the issuance that we did in early April, so 3-month paper typically. So, and that obviously came with an elevated cost early in the quarter, and at the same time receiving basically no return from the Fed. So you have a double whammy, you can say, low return from the Fed, but also temporarily higher funding cost for that position.
Yeah. Okay. Good. Thanks. And then just. Can you confirm that you haven't taken any form of government support during the quarter, from the TLTRO or the 500 billion Riksbank facility?
Yes.
Okay. Do you think that will be a relevant argument or an important factor in the potential dividend discussions during the autumn?
I don't make any guidance on that or do any judgment on it. We will have to wait, and then we leave that to the board and the AGM to decide.
Okay. Thank you very much.
Thank you. Our next question comes from the line of Sophie Peterson of JP Morgan. Please go ahead. Your line is open.
Yeah. Hi. Here is Sophie from JP Morgan. I was looking at your stage 2 exposures in the report, and they went up quite materially. But then when I look at the provisions, they only went up around 200 million versus the increase in the stage 2 exposures of almost 25 billion. Could you just explain why stage 2 exposures went up, but why provisions didn't really go up?
Hi, Sophie. It's Lars here. So basically, the primary reason why you saw the increase in volume in stage 2 was the fact that we decided to migrate the COVID exposures into stage 2, the ones with a risk class normal or worse. We migrated them into stage 2, so that obviously lifted the volume in that stage. If you look on, either in the note in the report or on slide 33, you can then clearly see also the impact of provisioning of that move, which was 37 million. So, but the main reason for the increase in volumes in stage 2 was the move we decided to do.
But I'm sorry, I'm just a little bit confused how you can have over 20 billion increase in stage 2 exposures, and you just take and you have macro declining by 5% versus your expectations in the first quarter, but you only see a 37 million increase in provisions. It just sounds very, very low.
The 37 million increase is related to this move only. So, but again, I think if you look on slide 32, you get part of the answer to that question, because we have also added the loss given default numbers for COVID-exposed sectors. And as Carl and Carina talked about earlier, we have a lot of secured lending, but certainly also in the other sectors that are exposed, you can see we have fairly low loss given defaults. So even if you make harsher assumptions on PDs, the provisioning in the model or in the overlay isn't that much impacted.
But then going back to the probability of default, how do you arrive at some of these? I mean, hotels, for example, 1.6% probability of default under stress, when we know that most hotels, not just in Europe, but in Sweden, are under immense pressure and loss given default of 21% for hotels.
Yes.
Are they based on historic numbers, or how do you arrive at the probability of default?
Yes, there are. I think we have to leave time for other participants soon, but we can discuss this further in the afternoon, Sophie. But just to take that question straight away, I mean, hotels in our case means a lot of hotel properties, as we talked about in Q1. Hence the low loss given default there. We have collateral in the hotel properties. But then, yes, I mean, looking at the PD values, they are based on our historical experience of PD values in stress in the different sectors. But we can dwell more into this if you want in the afternoon bilaterally.
Okay, and just a final question. On slide 34, you say that core equity tier 1 improved by 50 basis points due to other. Could you just give details on what this other is that helped your core equity tier 1?
No, I mean, it's when you look at the capital development, you do have a lot of different small impacts related to calibrations of models and other things, and over time they typically sum up to zero, but this quarter they happen to be a relatively large positive. But it's a sum of a lot of different things.
Okay, thank you.
Thank you. Our next question comes from the line of Johan Hedblom of UBS. Please go ahead. Your line is open.
Thank you. Sorry to dwell on the asset quality question, but I'm just trying to understand, with the macro assumptions you've done, the loan loss ratio year to date is, not only below peers, but it's actually below your own historical average. So should we read that the book today is materially safer than it's ever been in the past? In that, I think, you've annualized 5 basis points of loan losses year to date, and I think going back to 2000, the average is, 6 basis points or so. And I guess your macro assumptions don't seem to be materially less severe than the peer group, and yet of the banks that have reported so far, we're looking at somewhere between 3 and 6 times the average loan loss level over the same period. So how can the outcome be so different? Is this just the effect of IFRS 9 that models between banks differ so much, or is there anything else we're missing here?
Well, it's a really good question. Thanks for that one. And yes, I think that this actually reflects a better asset quality over time. And I do think that most of all, we have improved the asset quality if you look back a long term now. And as well, we have improved it even further with moving the bank into the more focused bank. So yes, we do believe actually that we have better asset quality. And we obviously have lower absolute numbers now with a higher portfolio. But then again, I do think that we obviously not used to making manual overlays when we do credit provisionings, and now with Brexit we've done it, and now we've done it with COVID-19 as well, and that obviously puts a cushion on our IFRS 9 modeling, which should, if history is a good guidance to the future, which should guide on expected credit losses quite nicely. And obviously, as we said before, we have low correlation between macro statistics and defaults. So we believe we have better asset quality now, yes. We believe that the more top-down approach you have, obviously you're more likely perhaps to know less about your exposures and then move into even further provisioning. But that's for you to guide on. We're good with the provisionings we've done now. We know the exposures on the individual level, and we're fine with these reserves.
And then just the final thing, on dividend decisions or thoughts, how do you think about countercyclical? I mean, you mentioned that they might very well come back at some point. When you think about your capital planning, what kind of I guess the targeted it includes no increase, but presumably it's part of your thought process when you think about capital planning in a slightly longer term perspective.
Yeah, we obviously want to be well capitalized for the future, and obviously if we add back the countercyclical buffers, that would take the SREP up from 14 to ish 16 or 15.9 ish. If you then obviously we got the SME support factor a bit ahead, and that's adding 0.5 as well. So adding these ones back, we are at roughly 16.5, and then we're mid in our target range. So I think that might give you some guidance to the way we think.
And when you talked about increases in capital requirements going forward, apart from CRE in Sweden and Norway and Basel IV, is there anything else you had in mind?
No, I just think that there's a lot of uncertainty going forward. So we will have to wait for the autumn a bit and see what's going to happen with the crisis and with dividends and etc. And then we can plan even further.
Perfect. Thank you.
Thank you. Our next question comes from the line of Andreas Håkansson of Svenska Bank. Please go ahead. Your line is open.
Yes. Hi, everyone. We've gone through most areas, so just a few follow-up. Quick one just on Octagonen. Could you just confirm, is it so that if you decide that there's not going to be a dividend for 2019, that you can't pay any money to Octagonen?
It is so, yes.
Okay. Then next point, just sorry, coming back to the asset quality situation. Just so I get the numbers right, how big portion of the increase to 25.5 billion of stage 2 increase, how much of that was just to move in the COVID exposures?
We can come back with the number, but it was a very big part of it.
But still, your coverage ratio is now below 1%, which is significantly below, I think, all peers. You don't feel that you want to be on the conservative side and you rather see potential write-backs in the future? I mean, I agree with some of the other analysts that it looks quite aggressive, don't you think?
Well, let me start, and then Lars, you can add. I mean, being a bank which makes lending bottom up, doing it locally with a good knowledge of the client, and then we provision in the way we do. I mean, it's natural for us to try to guess the line as good as we can. And it might be, and I'm not going to judge the way other banks does this, but we obviously want to have the correct credit provisioning every quarter, and that's what the ambition been this quarter as well.
So basically, if there would be another bank that says that to take more overlay and general provisions now, which they expect them to meet specific provisions in the future, you would rather not see the same way, and then shouldn't we really then expect that if there's an increase in actual losses that you're going to see higher loan loss provisions in the future since you haven't taken it up front?
But we obviously had added the COVID-19 overlay. So that is...
Sure, but it's not a huge overlay, I would say.
Well, how long is it?
We might not come to a conclusion. It's just quite striking numbers.
And we agree with that one. Obviously, it is a low number on absolute levels compared to other banks. We're fine with this one. We think it reflects our credit quality.
And also just to add again...
Can I ask it once? Yeah.
Just again, I mean, I think a big difference, without judging any other banks at all, but a big difference between our portfolio and some other banks is simply the type of sectors we're exposed to and the share of portfolio exposed to certain obvious problem sectors. And also that's very well reflected in our stage 3 provisioning versus some of our peers.
Sure. No, I'm more thinking about stage 2, but can I ask, since you have this decentralized model, and I know that each branch basically gets its own P&L and they're being measured on that and compared every quarter between everyone, do you think that there is an interest on a broker branch basis to keep provisions down as long as they can, hoping things can be fine? And if you would take more overlay provisions, is that allocated down to the branches or is that kept on a central level?
It is allocated down to the branch levels, and it is supervised by the group credit department. So they're obviously in charge of the credit process and the way we do the provisioning. And then it's definitely correct that it's done on a local level, and all the credit losses are divided out there.
But I mean, on the contrary to what you might be suggesting, Andreas, I mean, the local branch has no incentive to try to hide things or delay things. On the contrary, they will start working with the customer, I would claim, earlier than the more centralized bank would to avoid problems. And I would argue that's one of the key reasons why our loan losses have been lower for a long, long time, that we take early action with the customer to simply avoid a loan loss from happening.
Yeah, no, that's fine. Thank you.
Thank you. Our next question comes from the line of Nick Davey at Exane BNP Paribas. Please go ahead. Your line is open.
Good morning, everyone. So 3 questions, please. The first one on SME lending rates. Just wondered if you had seen any repricing going on in the SME segment in recent weeks. The second question would be about this funding position in the US. And the low-risk nature of your banks come up a few times. I think you used Handelsbanken as an adjective earlier to mean low risk. So my question would be, given that this funding position in the US is introducing more volatility into your P&L than the loan loss side, is this something that you're structurally comfortable with, or do you think over time perhaps diversifying the funding sources makes a bit of sense? And then the third question is, thanks for providing in the report some details around repayment holidays, given I think the number's now about 50,000 clients across the different geographies in some. So I just don't have in mind a number of how many clients you have in each geography. So could you just touch on these 50,000 repayment holidays, in any countries? Is that a more meaningful portion of the book? And I just wondered if it sort of squares away with 2 bips of loan losses at the group level. Just any more detail would be helpful. Thank you.
Let me address the 2 last questions, and then I'll leave the first one to Lars. But then again, going back to the financing strategy we have, obviously what we do is we are a risk-prudent bank. We believe in having a really good liquidity reserves. We believe in matching the lending with the financing structure. So obviously it's not that it is a US question. During April and May, to some extent, the funding costs were elevated at perhaps roughly 1 percentage points higher than pre-corona levels, wherever you were in the world. We fund ourselves in dollar to some extent all the time. We haven't changed that one, and we don't believe we need to change that either. But the similar numbers would have happened whatever currency we would have funded ourselves in. And obviously since then levels have dropped down and are comparable to pre-corona levels. So the extra funding cost of 236 million will abate over the next and slightly into Q4, and that will drop off. The third question was, the repayment and the amortization holidays. We are 33,000 in Sweden out of these figures, which are then obviously, and in Sweden we can't see any reason at all that's because clients are strained. Rather it is just when you leave the offer on the table to skip the amortization and to do other things. 33,000 of our clients have chosen to do so. In the other home markets, the range goes between 400 up to 1,500, I think. So a very, very minor part of the client segments, all in all.
Yeah, even lower than that. In the Netherlands, around 30 customers, but still a very low share of the portfolio. Then on SME lending repricing, I think in general, Nick, you can say that I mean, initially in the quarter, the corporate lending pricing was a bit all over the place, and I think it's gradually sort of stabilizing and of course finding new levels reflecting the new market conditions, so to speak. But I wouldn't describe it as any significant repricing, but more adjusting to the new normal.
Okay, thank you.
Thank you. Our next question comes from the line of Antonio Reale of Morgan Stanley. Please go ahead. Your line is open.
Hi, good morning. It's Antonio here from Morgan Stanley. Thanks for taking my questions. I want to ask you about asset quality. I think we've discussed enough. Two quick, one of which is a follow-up on NII. It was a bit surprising, to be honest, to see such a big drop in the quarter. I understand the drivers, and you mentioned that some of this may reverse later in the year. So my follow-up is really, leaving aside the government fees and the increase in liquidity reserves, which you've already discussed, out of the other two drivers, how much do you expect to recover? I'm thinking about the lending margins, which I think you quantified in 151 million, and in the rate cut in Norway and the UK, which I think was 170 million. So how much of those two would you expect to be able to reverse later in the year? And my second question is actually linked to some extent, is more focused on the UK. Could you just speak to what your expectations are in terms of net interest margins and loan loss provisions in the division going forward, please? Thanks.
It's Lars here. Starting with the first one, out of the 170 for deposit margins in Norway and UK, as Carl said, around 80 of that is related to the notice period, so that should be clearly temporary. Then in terms of lending margins, we don't guide for that. We don't slice out how much of the 151 was temporary. All we say is that it was an unusually big impact on the lending margins in the quarter, which is quite natural given the big turbulence we had in the beginning of the quarter. So you will have to make your own assessment where that will go from here. It's not representing a structural change in margins in that sense. It is quite a bit temporary, but again, we don't guide on, and we don't know really how that will play out going forward. Then on the UK NIM, again, I mean, we don't give any guidance as such, but clearly we have seen for a long time in the UK a big pressure on mortgage margins, clearly. Now in this quarter, the mortgage growth was basically zero, so let's see what happens going forward. But we definitely come from a couple of years with quite some pressure on mortgages in the UK.
And perhaps if I can add, Lars, to the deposit margins, obviously when rates drop down to zero, margins might be lower, adjust to a lower level. But as Carina was pointing out at slide number 7, if we look back in the history of our other home markets which entered a zero rate policy, we've actually, our experience is that we had increasing volumes of the lending business, and volumes are the only decisive factor actually in the NIM figure or in the net interest income figures going forward. So margins tend to come and go, but volumes tend to be decisive of the net interest income. So future will have to show what the outcome will be, but our history says so.
Okay, thank you.
Thank you. Our next question comes from the line of Riccardo Rovere of Mediobanca. Please go ahead. Your line is open.
Thanks. Thanks for taking my questions. Sorry to get back to asset quality 1 second. One couple, if I may. First of all, I really don't understand. When I look at slide 17, if I understand it correctly, your total credit exposure is 3 trillion. Take out 700 billion sovereigns and institutions, you're left with 2.3 trillion. And if I understand it correctly, the PD stress has been conducted based on slide 32 on 220 billion. So if I understand it correctly, it's like saying that for you, only 10% of the credit exposure is vulnerable to COVID-19 and the rest is not. And I don't understand. First of all, if I understand it correctly, and second, if I understand it correctly, why should it be the case that 90% of your book should be immune to everything that is happening? This is the first question. The second question I have is, when I look at again slide 32, has LGD been stressed in your COVID overlay, or is just the PD that has been stressed? And the final question I have, sorry to get back, but when I look at slide 33, the 21 million, so everyone has downgraded GDP expectations, starting with the IMF, the European Commission, the ECB, everyone. Now, just plug in more challenging numbers into your models should give you a negative number, because the quality of the book cannot change in 3 months. The book, your large book cannot be changed in only 3 months. So I don't understand why, from a statistical standpoint, plugging, I would imagine, or even inventing numbers, and then time will tell whether those internal models will be right or wrong. But I don't understand, how can it be possible when the GDP is downgraded globally that you get a positive number? Just logically, I don't understand it. Sorry for this, but just to understand, because the feeling I have is that the way you calculate your credit losses is closer to incurred losses, given that you see no defaults out there, which is probably the reality. You charge less because in the real world nothing is happening, or not much is happening. Just sorry for this, but just to understand the way you're thinking.
Ricardo, we're running out of time, so let me try to answer your questions. So first of all, 90% of the portfolio, as I say, not stressed. Well, I disagree, because we have changed the macro scenarios quite a lot as we disclose, and that is obviously impacting expected credit losses in the entire portfolio. And the reason we do this is obviously COVID-19. And then your question on whether the LGD is stressed. No, it's the PD which is stressed. And this is a 1 year stress we do. So LGDs remain the same. And then I'm not really sure I got everything right in your last question, but you were sort of questioning the fact that we had 154 positive from the impact from changed in the portfolio. And yes, I mean, the portfolio has changed since Q1. Our portfolio keeps changing, and I would say improving every quarter. And you can see that on migrations. We take out volumes that have a higher risk, and we take in new volumes with a lower risk. And on top of that, this quarter you also had shorter maturity on some of the exposures. So that gives you that number.
The question was mostly on how can I get to a positive 21 million when everyone is downgrading GDP.
Yeah. Okay.
Globally.
Sorry. Let me take that quick. Let me take that quickly. Yeah. We have a slightly lower overlay this quarter, 21 million, as I say, simply because we have updated the macro scenarios. So the entire portfolio is now capturing better the impact of the COVID pandemic than it did in Q1. So that's why on the margin the overlay has decreased somewhat. And Ricardo, more than happy to discuss this more bilaterally, but I think we have one more question on the list. Let's try to take that quickly as well.
Yeah. Makes sense. Thanks.
Thank you. The next question and the final question comes from the line of Martin Leitgeb of Goldman Sachs. Please go ahead.
Yes, good morning also from my side. Just a couple of follow-up questions, please. And the first one, you mentioned competition and expectation of competition to remain intense. Could you just differentiate between mortgages and corporates, how you see competition evolving in those two key product areas? And then secondly, in terms of capital and capital headwinds, just looking at your strong capital print this quarter, up 110 basis points, you continue to provision for a 40% payout ratio in terms of the 2020 dividend. Could you just remind us what the kind of the capital headwinds you're expecting either this year or the medium term for the group? And finally, in terms of dividend and potential dividend resumption, I was just wondering if this essentially mainly a question of having more certainty on the outlook and then to recommence with a similar dividend mechanics as we had them before, meaning annual dividends? Or do you also see scope that the dividend approach might change in the future, if uncertainty were to prevail, maybe going to quarterly, etc.? Thank you.
Let me start on the capital side, and then I leave over to you, Lars. First, as you say, yes, we're 470 basis points above our target. We like to, as we said the last quarter as well, we like to plan our capital situation based on a normal situation. Right now, we have an abnormal situation with the countercyclical buffers being removed. What we plan for them to get back sooner or later. We know that the CRE floors will add in Norway will add 0.3. We have a lot of uncertainty with dividends. We obviously have an uncertain market level. So we don't see this as anything which will change our strategy right now. What we pointed out with the 40% accrual in Q1 was that that shouldn't be seen as a long-term guidance on the dividend level we make. It should just be seen as the history and the way you do accrual should have implied 75% accrual ratio going forward, and that we thought was not a fair assumption, being a bank with a growth ambition. So that's the reason for accruing 40, and it's so far too early to tell what we will do in the future.
And then final comment perhaps on competition. I mean, as Carl said, we can clearly see that banks are in good shape, and we also know that we have proven again, I think, that we have very good customers, and I think all banks want to bank with good customers. So I mean, we can expect competition to remain tough, both within the mortgage side and on the corporate side for the good customers.
Perfect. Thank you. Thank you very much.
Okay, thank you all for this taking your time to listen to us. All the IR people are happy to get back to the questions you want to, and otherwise we will meet some of you during the coming days on the roadshow. Thanks all for listening.